Okay, so today we're doing two small sections of work. We're going to look at events after reporting date first. And afterwards we're going to look at fair value. Two sections of work that combined in the exam would be maybe about 10, 12 marks. So we're going to start with events after reporting date. When we look at financial statements, we have a certain number of time periods that occur where the year end might be there. The financial statements get prepared here, and the financial statements get approved at a later date. If the year end is December, we're really looking at financials being prepared sometime February, March, sometimes even later, May, because it takes quite a bit of time to get all the information and everything together. Then, once the financial statements are ready, they set a date for the AGM. And at the AGM, the financial statements get approved by shareholders. And then this is the date that the financial statements are signed, isn't it? Once the financial statements have been approved, that's the date of signature. And when we're looking at events that have occurred after reporting date, we're looking at events that have occurred after the year end during this period. Predominantly during this period. So the financial statements have yet not been issued. And so the question is, do we adjust them or don't we adjust them? And maybe actually it's more that period. The financial statements are prepared, but they haven't yet been signed and sent. So something happens, an event happens. And this event happens during this time. So the first definition that we're looking at is that we need to have had an event that happened after reporting date before the financial statements are signed and approved for issue. Once we've met that first part of the definition, then the second part of the definition is the classification of these events. And these events are classified either as adjusting events or non-adjusting events. And you're going to come across both of these in your questions that you get, non-adjusting events. So the first definition is it an event after reporting date or not? The second piece of the definition is it an adjusting event or a non-adjusting event? Adjusting events are events that give more information or provide information about a condition that existed at year end. Let's assume my event is a liquidation. One of your clients goes into liquidation. Once the client's gone into liquidation and you look back at the conditions or the circumstances, you realize that the client was already in great difficulty at year end. And so the event, which is the client going into liquidation, is giving you information about a condition, financial difficulty, that existed at year end, isn't it? That's an adjusting event. And what do I do when I have adjusting events? I adjust, isn't it? The condition existed at year end. At year end, that receivable was bad, isn't it? And so therefore, you would adjust at year end. Another thing that could happen, after year end, you identify that certain inventory can't be sold. It's been damaged. It can't be sold. When you investigate, you figure out that there had been some leak, flood in the warehouse before year end, and it had destroyed the inventory, but nobody had been aware of it. And when you then tried to sell it, you realized that now it had got wet and was damaged and couldn't get sold, isn't it? At year end, that inventory was bad. I need to adjust. And so in this case, we would actually do a journal entry and fix the numbers. Yeah. And in an exam, you would be asked to do a journal entry. Non-adjusting events give us information about conditions that arose after year end. So if I use my same two stories, one of your client goes into liquidation. One of your clients goes into liquidation after year end. You investigate and you realize that it was because of one of the client's licenses that was revoked after year end. So your client had a license to distribute a certain product, and then after year end they took his license away. Or it could even be like if you operate in certain industries, like medical, or something happens and they take away your license, isn't it? You did something negligent and they take away your license. So one of your clients goes into liquidation, and when you investigate, you realize that it was something that happened after year end that caused that liquidation to happen. Do you agree that the condition did not exist at year end? The condition arose after year end. When we have these, we don't adjust. We don't adjust because at year end, that client was still good, isn't it? But what we do is if it's material, we disclose. And we disclose facts and we disclose effect. Financial effect. So what we would say is, after year end, due to the revoking of a license, this client or customer of ours went into liquidation. The effect is that we won't be able to collect and we'll have to write off a certain amount of debt, isn't it? Another example of a non-adjusting event, we realize there's inventory that's been damaged that can't be sold. That inventory was on hand at year end and now it can't be sold. But when we investigate, we find out that the inventory was damaged after year end, isn't it? After year end, there was a flood and damaged all our inventory. At year end, was that inventory good? It was, isn't it? The condition arose after. So we don't adjust the inventory that's sitting at year end in our financial statements because that inventory was good. But if we had to write off a whole warehouse of inventory, it's material, do you agree? And I should tell my shareholders because it will affect next year's results. So I should say, as a result of a flood, all the inventory in a certain warehouse was damaged, and it caused a big write-off. I had to write off however many million rands worth of inventory, isn't it? And then you could even disclose that maybe you were insured and you are negotiating with the insurance about recovering it, but that there's uncertainty about that recovering. So, events after reporting. We first, and sometimes they ask little discussion questions for you to discuss what if this is an event and what kind of event. So you would start here and say, is it an event after reporting? Did something happen after reporting date before the financials are signed? And you would be looking at dates, isn't it? And then you'd say, yes, it is. And then your next step would be to say, if it is it adjusting or non-adjusting? Did the condition exist at your end or did the condition arise after your end? If it existed at your end, it means in my financials there's inventory or receivables or an asset, something which is now being mismeasured or misrepresented, isn't it? Incorrect. And so therefore I need to adjust. Or no, the condition arose after your end and so there's no adjustment and all I do then is I disclose. Okay. In your study guide there's some examples. The first one, come on. The first set of examples are on page 159. So 159 is an example, or examples of adjusting events. Adjusting events. The entity must adjust the amounts. So let's have a look at some examples of adjusting events. The resolution of a court case, because it confirms that the entity already had a present obligation at reporting period, and so therefore we would adjust a provision or recognize a provision. If there was a court case and at year end it was ongoing, do you agree? It needed to have been there already at year end. And after year end it gets finalized. And as a result of finalizing it, you now have a better idea of how much you owe. Then you need to adjust that provision, isn't it? So the resolution of a court case. So the court case needs to have already been there and then gets resolved. The receipt of information indicating that an asset was impaired. So an asset was impaired at the reporting date, but you only find out afterwards, after you've done your financials. You need to go and adjust for that asset. They've given 2 examples. The bankruptcy of a customer, which occurs after reporting date, usually confirms that that loss already existed before, and we would need to adjust. Usually if a customer goes bankrupt, it probably means he was in trouble before, isn't it? So there would be unusual circumstances like that one where they took away his license. But usually it would otherwise mean that it had already existed. And the sale of inventories at realizable value would give you an indication that there was something wrong with those inventories already, isn't it? Unless there was a special circumstance. The determination of the cost of assets purchased or proceeds. So after the reporting date, you're able to determine the cost of something. Yeah, so you weren't able to measure it before reporting date. You had sold or were in the process of selling some assets, but the price hadn't been finalized, or buying assets and the price hadn't been finalized. It was dependent on something, but that price was then determined after the reporting date. You can go and adjust it then, isn't it? The determination after reporting of the amount of profit sharing or bonuses. The determination of bonuses. Because that's also something that at year end, it's difficult to say what the bonuses will be, especially if it's profit share, because we haven't finalized profits. But once you finalize profits, then you know what that number is, isn't it? So if after that, if before the financial statements are signed, you're able to determine a better number for bonuses or profit share, then you can go and adjust that, isn't it? The discovery of fraud or errors that made the financial statements incorrect. Those also would be adjusted. Is that the next page that I've got? Yeah, I think that's it. There's an example of an adjusting event. But I think it's I'm not even going to look at it. It's not really an important one. I will go through an example that has the disclosure, etc. Then on the next page, page 160, are some examples of non-adjusting events. Non-adjusting events, we remember, just disclose. We disclose if they're material. So these are some examples of non-adjusting events. A business combination. So I acquired a subsidiary. I did a business combination, a group, in terms of IFRS 3. Business combinations or disposal of a business combination. Those would be big things for a company, isn't it? So if after year end I've acquired a subsidiary or sold a subsidiary, then it wasn't there at year end, so I don't fix it, but I should disclose it in a note, isn't it? And say, after year end this has occurred. Announcing a plan to discontinue an operation, a discontinuing operation, that we would also disclose. So if after year end I decide to close a branch. Major purchases or disposals of assets. It needs to be major. It can't be just in the normal course of buying and selling assets. The destruction of major plant by fire after reporting. A major restructuring. Needs to be big things that have happened after year end, which have arisen after year end. Major share transactions, if I've issued shares or done rights issues or things like that. And then abnormally large changes in asset prices or forex. So if after year end, let's say I had some investments and after year end the price changed drastically, I would disclose it. At year end the price was still what it was, isn't it? But if after year end, say the price drops, I would disclose it. If I have forex exposure and after year end something horrible happens to the rand, I would disclose it. Okay. Changes in tax rates that are announced after reporting period. You know from tax that if a tax rate is announced before, then I adjust it, isn't it? But if it's only announced after, then at year end I still go with the old rate and I would just adjust, I would just disclose it. Significant commitments or contingent liabilities, and any major litigation that arises after year end. So if we get sued or sue someone after year end, then that also would be an event after reporting. Dividends, by the way, declared after reporting are non-adjusting events. If I declare a dividend after the reporting date, then I don't put it into my numbers. It goes into the numbers next year. It was only announced, it was only declared the next year, but it's disclosable. So I would disclose these dividends declared after reporting date as a non-adjusting event. There is one exception with non-adjusting events, and the exception is going concern. With everything else, if it arises after year end, I don't adjust, isn't it? Going concern is the one exception. And what happens with going concern is that if I find after year end that the company is not a going concern, then I have to adjust my basis for accounting, isn't it? So let's see. See what they say, if they say anything. Oh, come on. No. So just note that going concern is the one exception, but you deal with going concern more in auditing, because there's actually a standard in auditing on going concern. So that's where you would deal with it. But going concern is the one exception to non-adjusting. And what I mean is that if I find that I have a going concern problem, even if the problem arose after year end, I would still adjust the way I prepare my financial statements. I can't prepare my financial statements on a going concern basis. I would then have to prepare them on a liquidation basis, but that's something small. Okay, busy bees, page 162 is the one that has the examples with the journals or the disclosure. So busy bees, page 162, 163 is your disclosure. Is your disclosure example. Okay, so this is disclosure. So it says, Busy Bees makes computer equipment. Year end is 31 December. Financial statements were finalized 16 Feb. So there's my dates, not 3 dates in this case, just the 2. 31 December is my year end. And financial statements were finalized 16 Feb. 16 Feb. So anything that occurs between 31 December and 16 Feb would be events after reporting date. All right, let's see what stories they have for us. Number 1, the market value of an investment decreased in January to 600,000 Rand. Investments are stated at market value. Assume the company does not speculate with shares. Adjusting or non-adjusting? First of all, is it an event? Yes, it is. It happened in Jan, isn't it? Adjusting or non-adjusting? At year end, was the investment reduced by 600,000 Rand? No. So therefore, it's a non-adjusting, isn't it? It's a condition that arose after year end. And so therefore, non-adjusting events, I would disclose. Here is the note. Sorry, that's theory. No, it obviously does start on that page at the bottom. Oh, come on. Here we go. No, there's all stories. Here's the note here. Sorry, I'm looking. They have a story and then they have the actual action. Here's the note. You can see the note is tiny, isn't it? So it's worth about 3 marks, if that. If it's a note, it's just a tiny note. It says event after reporting period. It discloses the facts and the effect, the amount. The market value of the listed investment decreased to 600,000 Rand in January 2012. Okay. So very, very small notes, these ones. All right, the second story, a debtor with a balance of 71,500 as at the 31st of December, it was declared insolvent and placed into liquidation on the 20th of January. The liquidator indicated creditors will receive 30 cents in the rand. So I'm going to get 30 cents for every rand in the 71,500, and 70 cents I'm going to write off. Right, so let's just see how much that write-off is. The write-off is 70 cents. So it's 50,050 is the 70 cents. Let's have a look at the, do you agree that it is an adjusting event? I'm going to have to write down that number because I'm assuming if you don't get given additional information, you assume that if there was a liquidation, that the debtor must have been in trouble at your end. I'm assuming that debtor was in trouble at your end, and so I would process a journal. Here's my journal. Journal entry for an adjusting event. I will process a journal. The journal is to debit allowance for credit losses, expense, and to credit my receivable. Journal entry. I would just say bad debts. I actually wouldn't even have said allowance. So we're assuming that it was already provided, I suppose, if you say allowance. But there's your write-off. You're writing off 70 cents in the rand, 50,050. Okay, and the next one I think is a dividend. There's 2 more. On the 15th of January, the directors declared a dividend, 10 cents per share. There are 100,000 issued shares. This is a non-adjusting, isn't it? Because look, it happened on this date. We've already talked about the fact that dividends are non-adjusting events if they happen after year end. So that one would just be disclosure. Once again, if I look here, here's the dividend disclosure. And the note really is a small note. On the 15th of January, the directors decided to declare a dividend of 10,000 Rand for the year ended December. Okay, we've got one more. In January, inventory with a value of 20,000 Rand was destroyed when the store was burnt down due to political unrest. So January, it is after reporting date. Do you agree? When did the condition arise, the political unrest? It arose after year end, isn't it? Arose after year end, so therefore it is a non-adjusting event, and I will disclose it. Let's have a look. Next page. Here in January 2012, inventory with a value of 20,000 Rand was destroyed when whatever. So you can see that the difficulty, or it isn't really a difficult section, but the key thing is to get it right whether it's a disclosable, adjusting or non-adjusting event. If it's a non-adjusting event, it's a note, it's a very simple note, isn't it? It's worth 2-3 marks at most, because you're just stating what they told you in the question. If it is an adjusting event, you would need to do a journal entry to do the adjustment. They'll ask you to do a journal entry. Or, do you remember in the tax section, we sometimes had to adjust profit before tax. They would say to you, do the adjusted profit before tax. This might be one of the things that adjusts the profit before tax, isn't it? They say to you, after we prepared financials, we identified that this debtor needed to be written off or this inventory needed to be written off. You have to go adjust profit before tax. So you'll either see it as a journal or as an adjustment to that profit before tax, so that you can start your tax calc with the correct number. Okay. So that's events after reporting. I think, there's another example, 5, but I'm not even going to go into that example in any amount of detail. You can see, example 5 you can have a look at, but normally I've not seen this examined, because in this module, the one they like to ask as a theory question is framework. And then sometimes revenue, they like to ask as theory. But you can see this one was a discussion question. Do you see? Discuss the appropriate accounting treatment. And when you look at the solution, they start with theory. Remember I said to you, it's always theory, and then application, and then conclusion. So then that's theory, that's application, and then this is the conclusion and the recommendation about what needs to be disclosed. Here are the 3 pieces. Okay. Morning. Car problems. Oh, your battery is flat. And now will it start?
Well, it's going, but I think I need to get it in for charging. There's an indicator. It's loose, and now it's always on. Not the battery's fault, it's the indicator. It's straight.
Okay. So that's the one section of work, tiny. The other section of work that I wanted to do today is fair value measurement. Fair value measurement is IFRS 13, IFRS 13. It's a separate TUT letter. You guys have received TUT letter 102. Is it 102? Something like that? I think it's TUT letter 102. Let me see if I can find it. I think I've put it away. I'll bring it up. No, and I don't think I even have it here. Here we go. View tool. Okay, so here is a TUT letter 102, that deals with IFRS 13, fair value measurement. This TUT letter 102 is 27 pages long, and it is merely a summary of the IFRS 13 standard, right? It is 13 pages long, and it is a summary of the standard of IFRS 13. Just I'm looking for my summary. Here it is. Actually, must keep it. Okay. In the exam, so you can see that it's a summary. Let me take you through high level what's in this IFRS. So it starts with an introduction. See, no, I actually can't do it like that. I think I have to do it with these up here, is it? Okay, no, let me navigate over here. All right, so it starts with an introduction. IFRS 13 measures fair value. So you know in various standards that you're going to come across in the syllabus, in the other modules, not so much in this module, we talk about measuring assets at fair value or measuring liabilities at fair value. Yeah. IFRS 13 is the statement that tells you what fair value is and how to determine fair value. So you'll see it starts off with the objective and the scope, and then it says what is the objective of fair value, how do we determine fair value, and then it talks about measurement, and it does a whole lot of definitions. These are all the definitions. You can read through the pages and pages of definitions, and it carries on. A number of pages of definitions, and then they talk about the different elements of the fair value, valuing assets or liabilities, what is an orderly transaction, who are market participants, what is price, then applications, highest and best use, a whole discussion on that, general principles, how we value liabilities held by other parties, initial recognition, using fair value when we initially recognize an asset, and then the various valuation techniques that would be applied. And then they go into those techniques: market approach, cost approach, income approach, the different inputs to a valuation technique, prices, market prices, quoted prices in the market, other than quoted prices, interest rates they talk about unobservable inputs, transactions that are not orderly, and then they talk about disclosure, and they go into all the requirements for disclosure, and then right at the end of the standard they give you an example of the disclosure, and you can see it's quite a lot of disclosure that's required for fair value. This is an example of the different items that are measured at fair value in my financial position, statements of financial position. There's the different items on the left, and then for each item I need to say what the quoted price is, if there's any other observable inputs, unobservable inputs, and any gains or losses on the remeasurement, and you can see that's a big note that you'd have to do in practice. And it continues for all my assets and liabilities with the stories. Yeah, 27 pages in all. Okay, let me go back here. You can go and study those 27 pages, right? Because in the exam, I have some of the exam questions here. They will ask you sometimes very detailed questions. They will say, for example, describe the characteristics of market participants in terms of IFRS 13. It's in that definition of market participants for 4 marks. Or they may say, what's the next one I have? Part 7 over here. Define the term fair value of an asset. State the reasons why transaction price and the fair value may differ. Very theoretical, isn't it? For 2.5 marks and 4.5 marks. But it's 27 marks of theory you have to learn for 6 marks, 5 marks, 4 marks, isn't it? You must decide if you want to go and learn it to that extent or not. If you want to earn those 6 marks, then you do have to go learn it to that extent, isn't it? Because you can see the way that the questions get asked is very theoretical. They expect you to know the exact stuff from the statement. Here's another one. Name 3 most widely used valuation techniques to determine the fair value of buildings. Advise the financial accountant which 3 factors should be considered in determining the highest and best use of buildings. Yeah, very theoretical. I can't give you that level of information or that level of knowledge in an overview of the standard. What I'm going to give you is an overview of the standard. What does the standard say about fair value? But be aware that this big picture that I'm going to give you is maybe not going to enable you to answer the question in the exam, because they could just focus on one little thing and ask you just that, isn't it? In which case then you just have to either have learnt it in detail from that TUT letter, or you have to just take a guess or a reasonable guess of what the answer would be. Okay, let's talk about what IFRS 13 says. So IFRS 13 measures fair value, and IFRS 13 starts off by saying that fair value is the price of an orderly transaction, between market participants at measurement date. So that's what the statement says fair value is. And it makes sense, isn't it? If I asked you what is the fair value of something, the fair value of something is the price. It's the price to sell. It's the price to sell or transfer, excluding transaction costs. No, there. Price to sell, excluding costs. So it would be the price that I'm using to exchange something, excluding transaction costs. Let me move some of these down a bit. It doesn't want to move that one. I'm going to have to just rub it out. But for some reason, it includes transport. Yeah, including transport. So it's the price, which is the price to sell, excluding costs, including transport. Orderly transaction, the statement talks about a market. It talks about an orderly transaction being the transaction in the principal market. If I'm buying or selling shares, that principal market is what? The stock exchange, isn't it? If I'm buying or selling fish, it's the fish market, in the principal market. What it also then says, oh, come on, what did it do now? It also says that if there isn't a principal market, you use the most advantageous market. So principal market is what we're going to look at first, or most advantageous market. So an orderly transaction is one that happens in the principal market or in the most advantageous market if there is no principal market. So if I can't find a principal market where something happens, then it's the most advantageous market. Between market participants. Market participants are the individuals that are then doing the transaction, isn't it? The people. And we're looking at it from the participants' perspective, isn't it? From their perspective and their assumptions. So here are the two market participants that are trading in this share. And then at measurement date, the statement talks about the fact that the asset must be measured in its current condition, in its current location, and what is the third one? With the restrictions that it has currently. So if I have a Porsche, but it's sitting in the Karoo, it's going to have a different value to one that's maybe sitting in Sandton, isn't it? If I have a car that is damaged through an accident, it's going to have a different value to a car that's been fixed. But I'm going to take it at measurement date in the condition that it's in, not the condition that it will be in once it's fixed, the condition that it's in broken. In the location that it's at, and with the restrictions that it has that apply. Okay? And that's the definition of fair value. Fair value is the price of a transaction to sell in an orderly transaction in a market, not sort of in the back alley or between friends, between market participants at measurement date. Yeah. It then talks about, especially when we look at assets, it talks about highest and best use. Highest and best use. So this price that we're determining is the highest and best use of the asset. Again, we're looking at the highest and best use from that perspective of those market participants that we had over there. And what the statement says about highest and best use is it talks about three things. It talks about legally possible, it talks about physically possible, and it talks about, did I say legal or legal, physical? And it talks about financially feasible. So highest and best use of an asset is what's legally possible with that asset. If I have a Ferrari and it can go at 240 kilometers an hour, that doesn't matter because legally I can only go 120. Yeah. What's physically possible with an asset? So you know how your car, my daughter always says to me when she's in my car, does your car really do, you know when you look at your speedometer, the car speedometers all go to about 2 something, hey, 240 or something like that. Then she says, can we try and see if your car... But I think, you know, sometimes it's just not physically possible, isn't it? So, I mean, if it's not physically possible, then it can't be the highest and best use. And then we're also looking at what's financially feasible. Yeah? Is it financially feasible or not? Okay, so highest and best use it then talks about. Okay? Then it talks about various valuation techniques that you would be able to use. And the reason that it talks about valuation techniques, we're going to talk a little bit just now about the levels, is that sometimes this price over here is not possible. Not all assets trade in a market, isn't it? And so sometimes assets that aren't trading in a market, it's impossible to get a valuation, and so we would have to use valuation techniques. There are 3 valuation techniques that they talk about in the standard. They talk about a market approach. A market approach looks at similar transactions, similar items. And here we're talking about properties, isn't it? My property, exactly as it is and where it stands, I'm not going to find a market that sells my property exactly, isn't it? Shares, I can find the exact share trading in an orderly market at the year end, and I can find a price. Properties, we can't really. So when we're doing valuations of properties, what we might have to do is look for similar properties in similar areas, isn't it, to try and identify a price. Market approach. The second approach they have is a cost approach. The cost approach says, what would I have to pay to replace that capacity? If I'm looking at an asset, what would I have to pay to replace that capacity of that asset? It might not be the exact same machine, do you agree? It might be a slightly different machine, but what would I have to pay in the market to replace that capacity? That's the second. And then the last one is the income approach. And the income approach is what we study when we do MAC. And it's discounted cash flows. Yeah. So if I'm valuing a property, let's say, I could look at similar properties in the market and what they're selling for. I could look at, if I wanted to buy a building that had 5 ensuite bedrooms and 2 lounges and 3 kitchens, whatever, what would it cost? Replacement. Or I could look at what rental income could I get from this property, and if I discount that to today, what is the value, isn't it? Income, cash flows. And that's what we do in accounting, in MANAC. Okay? In MANAC, when we're looking at values of an investment or an asset, we look at the present value of the future cash flows. So that one there would be the present value of the future cash flows discounted at some discount rate. So those are the 3 valuation techniques that are available. So IFRS 13 starts off by defining what is fair value. It then looks at highest and best use of an asset. It then talks about the available valuation techniques. And then, let me just do it on a different page. IFRS 13 sums up by saying that there are 3 levels of fair value hierarchy. I can't spell hierarchy. It's got an extra R, isn't it? Hierarchy. Is it like that? Yeah. 3 extra. So IFRS 13 then talks about a fair value hierarchy. And what it says is that once you've looking for a price in the market, doing a valuation technique, identifying highest and best use, once you've done all that, then to determine fair value, you're going to go through the hierarchy. Yeah? Number 1 on the hierarchy, level 1, is quoted prices. And that fits in with the definition, isn't it? The definition is price. Quoted prices, active market, identical assets. Level 1. Our favorite, the best, but level 1, we're probably only ever going to be able to use when we're valuing shares. Do you agree? Or bonds or debentures. Why? We're looking for quoted prices in an active market of identical assets. We're only going to find it if we have quoted shares or debentures or bonds or something like that, investments. Okay, level 1. Then, level 2. Level 2 is if we can't find a level 1, we move down our hierarchy to level 2. Level 2's hierarchy says observable inputs. What does that mean? It means quoted, it's either not quoted, not identical, not an active market. And when we have these, what we would need to do is make adjustments. So this is an example of when we're valuing property, isn't it? If I'm valuing property, there isn't an active market with quoted prices for property, but there are prices. You can go to the property, there's like a registrar, and you can go and look to see which properties have sold in which areas for what amounts, isn't it? So you can go and look at prices that are not quoted for properties that maybe are not identical in a market that might be active or might not be active, I suppose, depending on where it is, what location you're selling property in. And you go and look at these prices, but they are observable. So that's important. They are observable. Anybody could go and look at those prices, isn't it? Observable inputs. But it's not quoted, it's not identical, it's not an active market, or it's not all three. And so therefore I would then make adjustments. So if I can find a price that a similar building to the building I own sold for, but in a different area to where I have my building, I can start with that price and then make adjustments for area. Do you agree? Or I can find a building that's slightly smaller in the same area and take that and make adjustments for size. Okay, so level 2, observable inputs, but not identical, not quoted, not an active market, and then I would make adjustments. So that's the second on our hierarchy. If we don't have a level 1, we go to level 2. If we don't have a level 2, we go to level 3. And level 3 is where we have unobservable inputs, and you saw those in the disclosure. And unobservable inputs is where there isn't really a price that you can go look at or a market that you can check. But with unobservable inputs, this is where we have those valuation techniques that we spoke about. And so, ideally, therefore, when we are doing fair value for an asset that we have in our financial position or a liability, if the liability is measured at fair value, we ideally start with level 1, a quoted price in an active market of an identical asset or liability. If that doesn't exist, we move one down and we look for similar assets, maybe in a market that's not quite so active, maybe in a price that's not really a quoted price on an exchange, for example. But if we can't get that either, we then have to move to level 3, which is to do a valuation. Yeah, and you know that in PPE, when we do PPE, we usually land up on level 3, don't we? Because we get the sworn appraisers to do the valuation, isn't it? And then they use different techniques. So that's the fair value hierarchy. And this fair value hierarchy is then what's disclosable in your note. This fair value statement in this module is very sort of blinkered. You would never be asked to do the disclosure because none of the items that are measured at fair value are dealt with in this module. Yeah? If you think about this module is tax, changes in accounting policy, events, provisions we're going to look at, and revenue. None of those are measured at fair value. The things that are measured at fair value, investments, PPE, investment property, is in FAC 3702 predominantly, isn't it? In FAC 3704, measure assets and liabilities acquired in a group at fair value. That one's got fair value. So there's fair value in some of our other modules, but not in this module. When you get to honors, you'll see the integration. And then you'll see this disclosure. And then you'll have to, they'll give you, instead of now what they do in FAC 3702, which is they say to you, the fair value of the investment property is this. When you get to honors, they'll give you a whole lot of different values. And you have to apply the hierarchy and decide which one is the one that you're going to use, isn't it? So for your purposes, although there's that note, you saw it, a big note, and there's this whole lot of disclosable items, including along this hierarchy, which assets have been measured according to what level of the hierarchy. You will not be asked that in this module because of the fact of what's included in this section. What you will be asked is theory. Yeah? So if we just go back to the main principles, the definition of fair value, price of an orderly transaction between market participants at the measurement date. When we're looking at an asset, we look at the highest and best use for that asset, what's legally possible, physically possible, and financially feasible. And then we look at the different valuation techniques that are available. There are 3. Market approach, similar items, what they're trading for in the market. Cost approach, what it would cost to replace the asset. And you know that when we do PPE, we use the replacement, isn't it? Because PPE revals is net or gross replacement value. So we work with replacement there. Or the income approach, which is your discounted cash flows that you know from MAC. And then in terms of deciding which one you're going to use, there's this hierarchy, which says first use the prices in a quoted market. If that doesn't exist, try to find prices maybe not in a quoted market or maybe for similar items. And if that doesn't exist, then do a valuation technique, level 3. Okay. the questions in the assignments. Let's just go through them again in the exams. We're going to come across these questions when we do the exam papers. But you can see that they are small. 4 marks, this one. In terms of IFRS 3, market participants are buyers and sellers in the principal market for an asset or liability. IFRS 13, fair value, identifies the characteristics of these market participants. From the high level I've given you, I've said nothing about characteristics of market participants. If you got this in the exam and you had learned that high level, you would be going, yeah, I don't know. You'd have to try and like thumbsuck some things, isn't it? What is it that a market participant in a orderly transaction would have, would you say? Well, they would have to be somebody that has the ability to transact, isn't it? It's not good, like your friend saying that they'll buy your Porsche for R1 million. They don't have R1 million, isn't it? It has to be somebody that has the ability to do the transaction. It has to be somebody that has the information to do the transaction. So you would just try and come up with some things if this was you at this stage. If you, however, look at that number, that TUT letter, 102, right at the beginning of the TUT letter, they had all the definitions. Do you remember I said to you definition after definition? And if we look here at the definition for market participants is a big one. And they say they're buyers and sellers in the market. They are independent of each other, although the price may be used as an input, whatever. They are knowledgeable. They are able to enter into a transaction. What else do they say? They are willing to enter into a transaction. So those were the 4. There were only 4. So what do they say? Independent, knowledgeable, willing, and able. But, you know, really, you have to learn this in that amount of detail to answer those 4 marks, isn't it? Whether you want to do that or not, that's going to be up to you. So that was the answer for that one, for 4 marks. Every exam paper since IFRS 13 was introduced has a little bit. The next one, come on, behave. The next one is this one, this part B. It's usually a little part B. Glasgow acquired plant for R1.5 million. They want to measure it at fair value according to IFRS 13. They say, first of all, define the term fair value of an asset according to IFRS 13. What is the fair value of an asset? So we know what the definition of fair value is. It's the price in an orderly transaction of market participants at measurement date. We also know that an asset is highest and best use, isn't it? So I don't know, I would say something along those lines. But if you look at IFRS 13, there is a section that actually looks specifically at fair value of an asset, and they actually define it. Where was it that I saw it? There's the hierarchy. Yeah, I must have missed it. Okay, we can have a look at what they say in the solution. Let's have a look. I've got the solutions at the end. Okay, so there was the solution to question 8. It's exactly just a cut and paste from the TUT letter. Fair value, there we go. Fair value is defined as the price that would be received to sell an asset in an orderly transaction between market participants at measurement date. So we would have got that one. Yeah? We would have got that one. And then the next thing they ask in that question is they ask, no, it is this one. They ask, state the reasons why the transaction price and the fair value might differ on initial recognition. So when I first buy an asset, why would I buy an asset at above or below fair value? That's what they're asking in that question, isn't it? If you unpack it. Because what they're saying is, what are the reasons why your price and the fair value differ? Why would the price that you pay not be equal to fair value? Once again, if you look at the statement, there is a, I did see it here, I think it was here. No, it was further up. Fair value at initial recognition. There's a whole paragraph that deals with that. And they talk about here, for example, transaction price may not represent the fair value for any of the following conditions, and they give you the conditions. So if you had learnt it in detail, it's just recalled, isn't it? But you haven't learnt it in detail. So you have to try and think, what are reasons why what I pay for an asset might not be equal to the fair value of that asset? And what are reasons why? Can anybody think of anything? There might be transaction costs, unusual transaction costs, yeah? Adjustments. Yeah, I don't know. It's hard, isn't it? The main thing that they come up with actually has to do with related parties or duress. So they talk about that if the transaction is between two people who know each other, then maybe that price won't be a fair value price, isn't it? Because you're giving a special price to a friend. They also talk about a transaction under duress. So you hear of people immigrating and having to quickly sell their house, or people who have died and then their estate is quickly trying to sell the house, or in a divorce, isn't it? So if there are special circumstances of duress, then that might land up in a transaction that's a quick deal, isn't it? It's urgent, so therefore I'm going to accept a lower price. They also talk about transactions that are in a business combination. So in a business combination, things in combination would have a higher price than things on their own, isn't it? So if you're buying a number of different assets as a group of assets, it might have a bigger value than the individual assets on their own. The market in which the transaction is taking place is not the principal market. So instead of selling your share on the JSE and paying the transaction price, you sell it to someone not through the exchange or not on the market. So those were those examples, and when you look at the solution, you'll see that those are it's like a cut and paste, isn't it, of that. And in an exam, if you have the time to sit and try and brainstorm reasons, you maybe would come up with them, but if you don't, that's straight from that statement. The transaction is between related parties, takes place under duress, the unit of account is different, the market is not the principal market. So that, some of that question was okay, we would have been able to get, some of it we wouldn't have been able to get, it's something we wouldn't even have thought of yet. All right, so that was that one. This one here asked you down here, there were 2 bits for IFRS 13, 3 marks and 3 marks. It's usually about that, 5-6 marks. Currently, Lorna's Limited values buildings at historical cost, but they're considering valuing buildings at fair value. What are the 3 most widely used valuation techniques to determine the fair value of buildings? Well, the valuation techniques we learned, market approach, cost approach, income approach, isn't it? So, but you have to make it specific to valuing a building. So if we look at that solution, there's the 3. Oh, they just give them like that. Market, cost, income. So that one we did know, isn't it? Let's see what the other one was. Oh, come on. The other piece of the question, according to IFRS 13, the fair value of buildings should take into account a market participant's ability to generate economic benefits by using the asset in its highest and best use. What 3 factors would be considered? Those we also did look at, actually. Legally possible, physically possible, financially feasible, isn't it? So these ones actually were things we had looked at. So those 6 marks you should have been able to get. The next one here at the bottom, 5.5 marks. Squad Cars owns a warehouse in Benoni from which it distributes inventory. The warehouse has always been valued at historical cost, and now they want to use fair value. Define the fair value of an asset and state the characteristics that should be taken into account. I think it's that same stuff that we've just looked at. And then here are the solutions, so we can actually go to that solution and see. But I imagine the fair value would be price, received, orderly transaction, market participants, measuring date. Oh, and the characteristics actually now they're talking about those ones about measuring date. Condition, location, and restrictions at measuring date. Okay, so that's the two topics for today. Events after reporting date. In an exam, it would be like 3 marks. But the way that they ask it, let me see if there's one that I can find, one of those requireds that would have something that could show you how they ask that question. You see this, note C? Note C says, disclose transactions 5, 6, and 7 in the notes to the financial statements in accordance with IAS 8, which was accounting policies, changes in estimates and errors, and IAS 10, events after reporting, and IAS 37, provisions, contingent assets, contingent liabilities. So that's how they ask it. They ask it as one required for a ton of marks, 24 marks. But if we go look at transactions 5, 6, and 7, one of those will be a yellow. It will be a change in policy or an error or something like that. One of those will be an event after reporting, and one of those will be a provision or a contingent. And then the solution is to just put down those notes. That's how they ask it. So they won't ask it as a standalone, required. It will be asked like this. And we haven't yet done IAS 37, isn't it? So I want to leave that so we can practice questions once we've done IAS 37 and IAS. Then we can practice it with IAS 10 as well. Let's see what they have here. You see this one? Calculate the correct profit or loss before tax. That could be an adjusting event, isn't it? That could be an adjusting event. And then this one here, look. But there's no IAS 10 there. Disclose information 3, 4, and 5 in the notes for 16 marks. But here we don't see IAS 10 being referred to, which was the event statement. So I imagine that the event here must have been an adjusting event, and it must be part of this D, isn't it? Calculate the adjustment. Or maybe it was even the journal entry. No, this is a correcting journal, so maybe that's for an error. Yeah. You can see it's all integrated. Here's another one. But this one is also IAS 8, IAS 37. And this one here, yeah. It's just a story. Okay. So that's the 2 sections for today. I've got nothing else really to say, other than if you can just wait, I have to go make a copy, then I'll give you the notes. Pass this one round. What's left? 2 sections of work, provisions and revenue. Next week, provisions. The week after that, I'm away. Yeah? But I will remind you again next week. And then when I get back, we'll do revenue, and then we'll start past exam papers. Okay. All right. If anybody has any questions with stuff from other weeks or question, you guys should be starting to do some work, at home. Starting, because your assignments are basically all submitted. Am I right? Title letter 103 has all these questions by section. yeah, which you can do except for, well, you can't do like all of these from revenue and provisions, but up to 9 you can do. Especially the income tax ones, I think, are important. But you need to work through these before we start doing past exam papers. Past exam papers are all integrated, but this is section by section. Tat letter 103. You can't expect and wait for these tat letters to arrive, isn't it? So if they haven't, then you have to print them. If you don't have facilities to print, then go and ask Evie if it's possible to print there. Yeah. Tat letter 103, because then you'll get another tat letter. I see I don't have it yet, which will be tat letter 104, which will be the tat letter with the past exam papers. Okay.